Bullion Brief, where smart investors uncover the real story behind gold, silver, and the hidden forces moving global money before the headlines catch up. This morning, the market got another shock when fresh inflation data hit the screens, and traders immediately reacted across metals markets. Producer price data came in hotter than expected again, signaling that inflation pressure is far from finished. The moment those numbers dropped, gold and especially silver reacted aggressively higher, confirming what many institutional desks have quietly been positioning for over the past several weeks. Silver pushed through a major resistance zone that traders had been watching closely, and once liquidity above that level was taken, momentum buyers stepped in fast. Moves like this don't happen randomly. They happen when pressure has been building underneath the market while most participants are distracted by short-term noise. If you've been watching price behavior carefully, you'll notice something important. Before large moves, the market almost always performs liquidity sweeps. Price drops suddenly, weak hands panic, stops get triggered, and then the reversal begins. Earlier this week, silver experienced exactly that type of move, a sharp flush that convinced many traders the rally was finished. But instead of continuation lower, buyers absorbed supply and price recovered quickly. That kind of reaction tells you demand is sitting below the market, waiting for opportunities rather than chasing headlines. What separates experienced market observers from late commentators is timing. Anyone can explain a move after it happens, but reading market structure before expansion begins is where real understanding develops. Markets constantly hunt liquidity. They break important lows just to reverse higher, and they break highs only to trap breakout traders before pulling back. Once you start studying charts across multiple timeframes, the pattern becomes impossible to ignore. It's not opinion, it's repeated behavior built into how modern financial markets operate. Right now, silver is entering a phase where confirmation matters more than excitement. When price breaks a significant high, traders must watch whether candles actually close above that level. If price only spikes and leaves long wicks, that usually means liquidity was taken rather than true continuation beginning. But sustained closes above resistance signal acceptance of higher prices, and that's when trends accelerate. The next upside zones being discussed across trading desks are forming as momentum builds. But patience remains critical because markets rarely move in straight lines. What's drawing increasing attention globally isn't just chart movement, it's the growing difference between paper pricing in Western markets and physical demand in Eastern markets. In Shanghai and other major Asian trading hubs, physical silver continues trading at a noticeable premium compared to Western spot prices. When buyers are consistently willing to pay significantly more for real metal than futures contracts suggest, it raises serious questions about where true price discovery is happening. Temporary arbitrage gaps normally close quickly, but when premiums expand during rallies instead of shrinking, analysts begin looking at structural changes rather than short-term imbalance. At the same time, activity inside futures exchanges tells another story. During recent volatile trading periods, massive volumes of silver contracts changed hands within extremely short windows. Many participants who previously planned to hold positions into delivery instead accepted cash settlements and exited entirely. That behavior matters because normal market conditions usually show contracts rolling forward into the next delivery month. When open interest declines instead of rotating, it suggests some traders prefer stepping away rather than remaining exposed to delivery dynamics. While paper positioning shifts behind the scenes, physical demand continues showing strength globally. Reports from major bullion dealers across Asia indicate steady buying activity even during price corrections. Long lines forming outside precious metal dealers during pullbacks reveal a completely different mindset compared to speculative trading. Physical buyers often welcome dips because their focus isn't daily volatility, it's long-term preservation of purchasing power. That difference between paper speculation and physical accumulation is becoming one of the defining themes of the current metals cycle. Vault data has also started attracting attention. Withdrawals from storage facilities in both Eastern and Western markets have accelerated recently, reducing available registered supply relative to delivery obligations. Coverage ratios, essentially measuring how much metal exists compared to contracts demanding delivery, are tightening. When inventories decline while interest in ownership rises, markets become increasingly sensitive to demand shocks. Even small increases in buying pressure can create outsized price movements when available supply is limited. Another development quietly influencing sentiment comes from institutional capital flows. Large investment funds in emerging economies are receiving regulatory approval to allocate greater portions of capital into precious metals. This shift represents potential long-term demand rather than speculative trading bursts. As global wealth distribution gradually moves eastward, pricing influence may slowly migrate as well. Changes in how physical assets are valued across international exchanges could reshape how metals are priced over time. What makes the current moment historically interesting is momentum itself. Silver has been closing months consistently strong, forming one of the most persistent upward streaks seen in decades. Sustained momentum over long periods often signals structural accumulation rather than temporary speculation. Previous historical cycles show that extended strength without major monthly reversals sometimes precedes explosive phases, not guaranteed outcomes, but patterns markets have demonstrated before. Yet there's an important detail many analysts overlook. Retail participation today remains surprisingly low compared to past major silver bull markets. Exchange-traded fund data shows that large portions of the public are still underexposed to silver despite rising prices. In previous cycles, dramatic price expansions occurred when retail investors suddenly shifted from sellers to aggressive buyers. Markets that appear calm can become extremely volatile once mass participation begins because infrastructure struggles to absorb rapid inflows. History shows interesting relationships between equity market cycles and precious metals performance. Periods where stock markets stall or struggle to produce new highs have often been followed by capital rotation into alternative assets like gold and silver. Investors begin searching for stores of value outside traditional financial systems. Whether that pattern repeats exactly remains uncertain, but capital movement between asset classes continues to shape long-term trends. Geopolitical developments are adding another layer of uncertainty. Rising tensions in sensitive regions have increased demand for assets viewed as monetary insurance. During moments when global stability feels uncertain, investors historically move toward assets that exist outside banking systems or political control. Precious metals tend to respond quickly to these shifts because they function both as commodities and financial hedges simultaneously. Still, balanced analysis requires acknowledging risks. Exchanges can introduce rule changes during extreme delivery pressure. Physical premiums can temporarily decline if industrial demand slows. Geopolitical tensions sometimes cool faster than markets expect. Investor sentiment can reverse suddenly, especially if large ETF holders begin liquidating positions. Any of these factors could slow momentum or trigger corrections along the way. But markets ultimately reflect real behavior rather than hypothetical scenarios. Physical demand remains active, inventory trends continue tightening, institutional interest is expanding, and inflation data keeps challenging expectations of rapid economic stabilization. These variables interacting together create an environment where volatility increases and long-term positioning becomes more important than short-term reactions. What we're witnessing now may not simply be another commodity rally, but a developing shift in how participants view monetary assets during uncertain economic conditions. Whether silver continues accelerating or pauses for consolidation, one fact remains consistent. Understanding market structure, liquidity behavior, and global demand dynamics provides a clearer perspective than reacting emotionally to headlines. The real question every participant must ask is simple. Are you reacting to price movements after they happen, or are you learning how markets move before the crowd recognizes the shift? Because independence in markets comes from observation, verification, and patience. Study the data yourself, watch how price interacts with key levels, follow physical demand trends, and connect the information across timeframes. The market always leaves clues for those willing to look closely enough. This is market education, not financial advice. Always verify information and make decisions based on logic, discipline, and your own research.